Hi, friends. Chris McWilliams here, EST Home Mortgage. Just wanted to do a Federal Reserve update. We know we got the first cut in almost 4 years. Really, really great to see that. We're making progress. So, where do we go from here? Kind of what do we look at? Want to do an overview, give you my thoughts, and so that way you kind of have an idea of what we're looking at, and hopefully it'll help you. And so, Fed statement, they cut it by 50 basis points down to 4.75 to 5. Now, this is the overnight rate, right? This does not directly affect mortgage rates. It just indirectly affects mortgage rates. So, make sure that most clients are starting to understand that, but a lot of people think that it's directly to mortgage rates. It's not. One dissension, first dissension in 19 years, Michelle Bowman, she just not really with the times, honestly. Fed's dual mandate. So they're trying to keep inflation in check by also keeping maximum employment. So the jobs numbers, which I've shared with you in previous updates, seem to be overstated. They do reconcile that. The QECW came back and showed that they were much overstated. And so the Federal Reserve is now a little bit more concerned about the job market than they were previously, which is a good thing, which is partially the reason that this 50 basis point cut came into play. So, they said that they thought the economy is still on solid ground. I do believe that we're muddling through this inflationary period that we had. Muddling through is better than recession for sure. Certainly, I'm not a fan of these higher rates, right? It hasn't been good for us here in mortgage or real estate. So quantitative tightening. Right now, all of the securities, the treasury bonds and mortgage-backed securities that the Federal Reserve purchased in the COVID or even through the Great Recession, they're allowing them to roll off the balance sheet, the Federal Reserve's balance sheet. So as that happens, that's kind of a restrictive policy. And now that's probably good long-term for the Fed. Hopefully the Fed will be able to stay out of this market. We'll stop getting these big, huge swings, but we'll kind of see how that goes. If they were to stop quantitative tightening, that could affect mortgage rates lower, but they want to get those securities off their balance sheet. So next, what we're looking at here is this is their projection. So 2 more 25 basis point cuts this year if everything reports are good. Inflation's a little bit down, employment stays a little bit to the same, unemployment rate stays the same. We'll get 225 basis points in November 17th and December 18th. So mortgage rates have this priced in. So we're not going to get more drop in mortgage rates based off of this cut. So good thing to keep in mind. What's really driving long-term mortgage rates is inflation. So if we could get better inflation numbers, then we would continue to see a drop in the 30-year fixed rate. So that's really what we want to focus on. Like I said in my description email here, I'm not so sure in the short term we're going to get significantly better inflation reports. I think we're going to continue to trickle down. So I'm going to go back here a little bit. Go back one, and GDP and unemployment. So this is their unemployment numbers. I'm cautious about this. I think unemployment could stay there or get a little bit worse. If that happens, they may cut a little bit more, and that may also lead to lower mortgage rates. If inflation goes up, these cuts are off the board and mortgage rates will go up. If unemployment goes down and these cuts come off the board, mortgage rates may stay the same. They may go up a little bit, but they're really focused here on this inflation number. GDP good this year. They're forecasting a little bit down next year. Should be kind of normal. That 2% range is kind of where we've been normal. That would be good if everything works out. So the Fed governors do the summary projection. So this is where they had 2 at 0, 7 at 25, 9 at 50. So this is where they think 2025 there's going to be a quarter point cut. Quarterly essentially is kind of what now they meet more than quarterly, but 100 basis points next year. This is also what the mortgage bond market, mortgage interest rates kind of have projected in. So sometimes we hear families, they say, oh, we're going to wait for more cuts because they think mortgage rates are going to come down. It's not the way it's going to work. These are already priced in. So we're going to stick in this 5 to 6% range until inflation gets better. And then if you look here, this is what the Fed governors kind of think that the unemployment rate's going to be over the next few years, so 24 to 27, and we'll see if we stay here. Clearly we'd like it to be lower, but pretty hard to get lower unemployment when rates are still pretty high. So doesn't see a recession. 50 basis points was just a commitment not to fall behind, is kind of what his press conference was saying. And then market rents are decreasing slowly, but will take time to filter into the inflation report. And that's kind of what I was mentioning there a little bit too. The averaging that they use for the housing for rent and for owner's equivalent rent are certainly lagging. They use a 12-month average. It's looking backwards. It's not real time. So it's going to take a little bit to get there. So hopefully that helps, give you a little bit of guidance and, educate clients. If there's anything I can do to help clients, pre-approval, refinancing, I'm always here to help. Thanks, friends. Have a great weekend. Bye-bye.